All right, let's switch gears here back to the markets. The stock market's wild ride. Investors may be seeking safety in the bond market, including corporate bonds, but it's been a rough year so far, to say the least, for the credit market as the Fed and global central banks raise rates. Joining us now, we want to bring in Danielle, Poli, Oaktree Capital Portfolio Manager of the Oaktree Diversified Income Fund. Danielle, it's great to see you. Just your assessment right now of the credit markets and what we'll likely see here through the end of the year.
Well, thanks so much, Shauna and Dave and Rochelle, for having me. It's a pleasure. The markets have certainly been volatile, but volatility creates pockets of opportunity. And so we are viewing this dislocation as a possible buying opportunity in fixed income that can actually offer equity-like returns. For the first time, fixed income is really attractive again.
We're looking at another 75-point hike. Some feel a full 1%. Will things get worse before they get better given continued Fed tightening?
Yeah, there's a lot of things on the table coming up with the Fed's announcement about what they're going to be doing with rates. We don't forecast. We just look at what the opportunities are for us to invest in what we think are attractive companies with good underlying fundamentals that can weather the economy if things do get worse before they get better.
So then how would you compare the performance of the credit market versus equity markets right now?
Yeah, well, equity markets, I think, are being driven by investor sentiment and a lot of the mixed news that we've been seeing. Certainly rising rates and spread widening has also translated into some price declines in the fixed income and credit markets, but not to the same extent. And when I mentioned that fixed income markets can generate equity-like returns, our Oaktree diversified income strategy is actually investing in a portfolio of investments that are yielding north of 10% today. So highly attractive with what we think is still good downside protection that credit can provide to investors that have a diversified portfolio.
Danielle, talking a little bit more about the specific opportunities that you're seeing in the credit markets, where are they?
Well, we've allocated the portfolio in a combination of public and private debt. So on the public side, which comprises the majority of our investments, we have a very wide toolkit at our disposal. So we're investing in both high yield and syndicated loan markets, as well as other kind of more specialized niche areas like structured credit, particular CLOs and real estate debt, emerging market debt, and convertibles. Some of those areas offer a premium to kind of similarly rated corporate debt. CLOs in particular, an area that we find attractive. BB rated tranches of CLOs out yield BB bonds by over 500 basis points today, which we think is pretty good to get that diversification in a structured pool securitization. And then on the private side, these are investments that we're making in income generating, really stable kind of profiles of private companies that we source directly in a variety of different industries. And so they have offered higher yield historically, but kind of given the dislocation that we've seen in public markets, those yields are approaching around kind of the same area. And so having really a portfolio that can flex into both public and private at different types in the cycle is going to help investors, I think, capture the best risk-adjusted returns in this market.
Certainly opportunities to be found there, as you were saying. Thank you for joining us this afternoon, Danielle, Poli. Have a good day. Thanks so much.